All right, today we're diving into a pretty interesting corner of the financial world, one where your life insurance policy gets to play in the stock market. We're talking about variable life insurance. So, let me ask you a question. What if your life insurance policy did more than just sit there as a safety net? What if the cash value inside it could actually grow or, shrink based on how the market is doing? That's really the core idea we're going to unpack. So here's how we're going to break it all down. First, we'll look at how insurance and Wall Street came together. Then, we'll decode how these policies actually work. After that, we'll get into the big one, the risk versus the reward. We'll also meet its more flexible cousin, VUL, and then we'll wrap it all up with the stuff you absolutely need to remember.
Okay, Section 1, Insurance meets Wall Street. The best way to think about variable life is as a hybrid product. It's got one foot in the world of insurance and the other planted firmly on Wall Street.
So what is it exactly? Well, at its heart, it's a permanent life insurance policy, which means it's built to last your whole life. But here's the twist. It takes the death benefit you're used to and combines it with a savings part. And that part gets put into what's called a separate account to be invested in things like stocks and bonds.
And the second you start talking about securities, a whole new set of rules comes into play. This isn't just your standard insurance product anymore. Now the SEC is involved, which means more oversight. And it also means the person selling it to you has to be licensed for both insurance and securities. That alone tells you it's a more complex beast.
All right, let's move on. Section 2, we're decoding variable life, or VL for short. So let's follow the money and see how this thing actually works under the hood. It's a pretty straightforward process, really. First, you pay your premium, which is usually a fixed level amount. Then, some of that money goes into that separate investment account we talked about. And here's the important part. You get to decide how it's invested. You get a menu of options, kind of like sub-accounts, and you direct the funds into stocks, bonds, whatever's available. And this is the whole point. You're not on the sidelines anymore. You're directly involved. The growth or loss in your cash value is completely tied to how well the investments you picked are doing. You are officially in the driver's seat. Which, of course, brings us right to our next section, the risk and the reward. Because anytime you're in the driver's seat, well, there's always a big trade-off you've got to think about. This quote just nails it. With traditional insurance, the company takes on the risk of getting a decent return on their investments to back your policy. With variable life, they basically hand that risk over to you. The insurer gives you the car, but you're the one driving it, for better or for worse. So it's really two sides of the same coin. On the one hand, the reward. Your cash value could potentially grow way faster than in a traditional policy. We're talking market-level returns. But the flip side is the risk. There are no guarantees on that cash value, no minimum interest rate. If your investments do poorly, that cash value can absolutely go down. Okay, so hearing that your cash value can drop might sound a little nerve-wracking. But before you get too worried, you need to know that there's a really powerful safety net built in for the most important part of the policy. And here it is, the guaranteed minimum death benefit. This is so important. Even if your investments have a terrible year and your cash value tanks, the death benefit, the money your family gets, is protected. It will never, ever fall below the amount you originally bought. That core promise is safe. So now that we've got a handle on variable life, let's meet its very close relative in Section 4, Variable Universal Life, or VUL. Think of it as the more flexible, easygoing sibling. And honestly, the biggest difference is that simple. VUL takes that same investment setup from variable life, but it adds the premium flexibility of a universal life policy. So instead of being locked into a fixed payment, you get to adjust how much you pay and when. Let's just put them side by side here. See? VL fixed premiums, VUL flexible. Both have that guaranteed minimum death benefit, and in both, the cash value goes up and down with the market. But check out that last row. With VL, you can really only take out loans. With VUL, you can often make partial withdrawals. It just gives you more options, more flexibility. All right, we've covered a lot of ground. Let's wrap this all up in our final section, what to remember. Let's boil it down to the absolute must-knows. So, here's the rundown. First, remember it's a hybrid, insurance plus investments. Second, and this is crucial, you are the one taking the investment risk. That means the cash value can change and isn't guaranteed. But, and this is a big but, the death benefit is guaranteed to not go below what you started with. And finally, if you want more flexibility, VUL is the version with adjustable premiums. But look, if you only remember one thing from all of this, let it be this quote. Even with all this talk about stocks and market performance, at the end of the day, these are designed to be life insurance policies first. Their main job is to protect your family. They're not straight-up investment contracts.
And that really leaves us with a final thought. Variable life definitely offers you more control and more potential for growth, but that control comes attached to more risk. So the big question you have to ask yourself is a personal one. Is that a trade-off you're willing to make?